Hello, here is our September 2024 market update. September has always been a crucial month, and this time more than any. So we're going to go through the beginning kind of quick and then get to the meat of the subject.
I'm Max.
I'm Victor.
And Josh. We got Josh here too. All right, our underlying thesis. Number 1, 90% of the things we worry about never happen. Number 2, we make observations, not predictions. And finally, number 3, the simplest explanation is usually the best one. And finally, Economics 101, supply and demand applies to most markets as well as most products. All right, Vic, how are the
major market? The Dow, as of last Friday, up a little over 7. The S&P 500, a little over 13. And NASDAQ, a little over 11 year-to-date as of last Friday.
All right, so the charts, the Dow Jones, you can see that it's in an uptrend, and then it's also in the long term, it's in an uptrend. In the short term, we're kind of going a little bit sideways.
Yep, and look at same in the S&P. Look at the green, the 20 DMA, 20-day moving average. We're moving sideways, but if you look at both the 50-day and the 100-day, we're in a confirmed uptrend.
And the NASDAQ, they all correlate with each other. The NASDAQ is in an uptrend on the long term. Short term, it's going a little bit sideways. All right, perspective, Vic.
I want to put this into perspective. I want you to listen to this for a minute. It is a gloomy moment in history. Not in the lifetime of any man who reads his paper has there been so much grave and deep apprehension. Never has the future seemed so dark and incalculable. The domestic economic situation is in chaos. Prices are so high as to be utterly impossible. The political cauldron seized and bubbles with uncertainty. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. And Russia hangs like a storm on the horizon of Europe, dark and silent. It is a solemn moment, and no man can feel indifference. Of our own troubles, no man can see the end. We'll get back to that.
All right, hurricane season upon us. If you're in Florida and you don't know hurricane season is upon us,
you're in trouble.
It is. Yeah, you're in trouble. All right, September is a hurricane month, both for weather and historically for the market. So ask yourself these questions. What's the most advisable course of action? Do you raise cash in anticipation? Or do you use an opportunity to buy the dip? We'll provide some food for thought with those questions.
Okay, the pros and the cons. Here's the short list. We'll then go into everything in detail. The pros, presidential election cycle. We'll show you the history. Fed announced rate relief is in sight. All 3 indices have made new highs. Technically, we are in a confirmed long-term uptrend, and there is a major technological boom. AI is just beginning.
All right, the cons. September's historical weakness. Valuations are a little high. Possible recession. Inflation is squeezing profit margins and high government debt.
All right, so let's go. Pros, the election cycle. You want to do this? Okay.
The election history. The S&P 500 index return in election year, U.S. presidential election years, on average is up about 11.5%.
And regardless of which presidency, election years are positive years over 80% of the time.
All right, new highs, Vic.
All 3 indices have made new highs in the last 6 months. The Dow, the S&P, and the NASDAQ. Over 80% of the time, when indices make new highs, 12 months later, they are higher.
All right, the Fed hints at rate cuts coming. Stable U.S. inflation keeps the door open for moderate Fed rate cuts. The Fed's preferred inflation gauge, the PCE index, was up 2.5% in July from a year ago, meeting economists' expectations. I can't say it. All right, both Vic and I agree that I think the Fed is going to do a 25 basis point rate cut.
I'll go with 25 too. If they did 50, it'd probably be too aggressive.
Yeah, I think it'd be too aggressive, and the market would think that we're gonna hit a hard landing instead of doing a soft landing.
Next, the Fed sees this consumer price index to support the rate cuts. If you look at that chart, you see the red line. That was the peak in the consumer price index. And you can see little ups and downs, but the trend is lower in inflation.
All right, technological boom, artificial intelligence. I'm sure you've heard of the word AI before. AI investment poised to broaden beyond semiconductors. So the cloud revenue is poised to reach $2 trillion by 2030 amid AI rollout. Much of the recent technology spending and subsequent rise in stock prices has centered around infrastructure companies like semiconductor makers. I'm sure you all have heard of NVIDIA. The next phase is expected to generate opportunities in platform companies that allow the best use of the infrastructure while providing building blocks for next generation applications, as well as software companies that generate AI applications.
I mean, just so you can say, Apple today made its announcement that the next iPhone will have AI
featured in it.
Yep. Okay, the cons. Season volatility.
All right, cons. September's historical weakness, valuations are high, possible recession, inflation squeezing profits, and the high government debt.
September historically has been one of the poorest months. If you can see on the left where it says we are here, we're in that part of the season, that part of the year where the markets go sideways to down. And if you look on the right, the average return for the September since 1954 has September as a losing month. But this year, we don't have an average September.
No. And also, we have to be aware, look at those three. August, September, and October are the three worst months for the market if we look at that chart. And so just make note of that. It's a seasonal volatility that happens, but then look for November and December are skyrocketing great months.
Yep, you'll actually see November, December, and January are three of the strongest months of the year. This is not the right time to be out.
Yes.
Okay.
All right, cons. Election volatility in December. The S&P 500 has only been up in September 50% of the time, dating back to 1950. And worse in election years, with an average return of 0.5% for the month.
So, right now, if you see that blue line across the center of the chart, that is quote unquote considered fair valuation. But everybody says the market's overvalued. Sometimes they say it's undervalued. But I want you to note the big mountain in the middle. It stayed overvalued for 10 years. Then we went down, it got undervalued. We've now been overvalued for the last 10 years. So we're overvalued, but how long can it be overvalued? There's not a definitive answer to that one.
And this is as of June 30th, and we've had quite a little bit of a pullback since then. So the value has gone down. So I don't want you guys to think that, the market's now overvalued. We've had a pullback, especially last week.
Yep.
We had a giant pullback. So, all right. A recession is still possible. So if we look at this chart, the core CPI versus the core PCE, a recession is still possible on this chart.
All right, now, company profits are getting squeezed. Regardless of what you hear of some companies taking advantage, here's what's happening to corporations. Input costs are going up. Pricing power is getting tougher. Consumer behavior is getting tougher. Inflation rates and financing costs have gone up. Wage pressures are there. Inventory and asset values are fluctuating. And we have a lot of changes going on in foreign exchange rates. So company profits are getting squeezed right now as well.
And I'm sure you're seeing it. I'm sure if you go on CarMax.com or you go on used cars and you start looking at used cars, inventory is going skyrocketing up there, especially in used cars. Those are usually a leading indicator that a recession is coming.
So next, our debt is at historically high levels. I want you to look at that chart. Again, the red line. The debt, and how they measure it is debt to gross domestic product, debt to GDP. We have not been this high in a debt to GDP ratio since the end of World War II. So I'm going to do this one. So remember this, I gave it to you earlier, putting it all together. Here, I want you to listen to this one more time carefully. It is a gloomy moment in history. Not in the lifetime of any man who reads his paper has there been so much grave and deep apprehension. Never has the future seemed so dark and incalculable. The domestic economic situation is in chaos. Prices are so high as to be utterly impossible. The political cauldron seethes and bubbles with uncertainty. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. And Russia hangs like a storm cloud on the horizon of Europe, dark and silent. It is a solemn moment, and we know, and no man can feel indifference. Of our own troubles, no man can see the end. Now, here's the kicker. Look at the bottom. This was published in October the 10th, 1854. I think we survived, didn't we?
Barely.
Barely, okay.
Neither one of us were born then.
I don't remember, but I think we're still here. I'm here, okay.
All right, so raise cash or buy the dips, the 1 month review.
Let me say something. We're going to give you, watch this. The big question is now, do you raise cash, you sell into this weakness, or do you buy the dips? We're going to look through a 1 month, a 1 year, and then a long-term horizon, and you make your own conclusion. 1 month, what the heck happened?
1 month, what the heck happened? So, as we could tell, on Wednesday, 7/31, the NASDAQ, everybody pay attention, this is the NASDAQ, was at 17,599. Let's call it 17,600. On August 5th,
A week later,
it dropped 2,100 points. That's because what happened in Japan, and then it dropped 6.5% a drop on the open on August 5th.
And then go ahead. Again.
Yep. Then on 8/2 in August 2nd. So on August 7th, it was at 17,149. So it came right back up. So on your far left, on 7/31, it was at 17,001. Let's say 600. And on 8/5, a week later, it was at 15,700. So it lost 1,800. Let's call it 1,900 points.
How long did it take to recover?
A couple days.
Really? Just had the next slide.
So it took another week basically to recover. It was at and go above it. It was at 8/16. You're at 17,631. So
that was the flash crash. We dropped almost 2,000 points.
6.5%.
Yes,
in 1
almost
day.
in 1 day. And what happened 2 weeks later? We recovered and went on. That's the 1 month. How about what happened in a year? How about last year?
You do the year.
Okay, here is why timing is so difficult. Last year, 2023, we had three, and the first one, by the way, it was into 22. We had three different drops in the market, anywhere from a 978 point to over 3,300 points. If you tried to time the market, not only did you have to know when to sell, but you also had to know when to what?
When to buy.
When to buy back in. You've got 6 decisions. Sell, buy, sell, buy, sell, buy. That you had to be correct for timing to work. However, if you just let it stay, what did you do?
You're up 14%.
By not doing anything and not panicking. We showed you the month. We showed you the year. You can just go ahead.
Well, and I just want to say one thing. In that one period in October of last year, that's when Jamie Dimon came out and said, we're going to experience an economic hurricane. And sure enough, he was incorrect. And up until now, we were from November of last year until now, we have had a skyrocketing explosion.
None of that. Before you do this, when this finished, it was like 37 and change. Didn't we recently break 40,000 on the Dow?
Yeah.
All right, so we did the 1 month. We did the 1 year. Max, what's next?
All right, the 82-year review.
Jeez, I don't know if I'm going to be around that long, but go ahead.
All right, so 82-year review. Raise cash or buy the dips. As you can see, the mountains in blue, those are bull markets. So the little valleys, those are the bear markets. So does it make sense to buy the bear markets? It looks like it,
yeah,
right?
And you got to be awfully good to figure out when the bear and when the bull is. Overwhelmingly, there's a lot more time in the bull than there is in the bear. As a matter of fact, you might have the statistic. What's the next thing?
Yeah, I think we do.
Okay.
We've had this statistic for a while. What does it read, Vic?
Bear markets, down markets, last an average of 11 months. versus bull or up markets last how long?
6.5 years.
So I got 1 year to 6.5.
I'll take the 6.5.
I'll take the 6.5.
All right, our conclusion. I'll do the first, you do the next, and we'll go
All right,
from there.
you
The
got it.
saying goes, it's simple. It's time in the market, not timing the market.
You think Warren Buffett times the market?
No.
No,
It's time in
exactly.
the market.
You got it. To time it, you have to have multiple sell and buy decisions, and you have to be right on all of them.
So we just reviewed the 1 month, the 1 year, and the 82
And the
year,
82 year.
year analysis. And what was our conclusion? Our conclusion is it's time in the market, not timing the market.
And conditions today are arguably a lot better than they were last year. We're looking at slowing inflation, lower interest rates, and a major technological boom.
Our conclusion, September can be difficult, but history leads to the conclusion to stay invested in the market and buy on the dips. October will probably, like we looked at, August was a little bit of it turned up to be an up month, but September's usually a volatile month and October's usually a volatile month. So just be cautious of those 3 months in the calendar year.
Absolutely. So I think that sort of tries to bring it all together. We try to bring some history into this and take out the emotion. It's hard to not be emotional when you see the market go down 1,000 points in a day or 600 points in a day. But what do they say?
Those that fail to learn from history are doomed to repeat it, and those that learn from history can prosper.
Our job, we take out the emotion and replace it with historical context.
Why does history repeat and so many fail to learn? Times change, but human nature doesn't.
That's absolutely correct. All right, thanks for joining us today. If you have any questions yourself, please give us a call. That's what we're here for. We're backing this up with data, with history, and we try to take the emotion out, and we try to give you a clear path. Remember, you've hired us to worry, so you don't have to. Anything else you want to put in there?
That's it. And remember, we're here looking out for you.